Right, okay, so we're looking at property, plant, and equipment. This is the support material for this particular module. The first question is, what do companies need in order to operate? So what do companies need in order to operate?
Financial statements.
No, the financial statements would be the information that they do for decision making. But in terms of operating?
Assets, liabilities.
Exactly, assets. Okay, not the liabilities, because here we're looking at property, plant, and equipment. Okay, so companies need assets. Right, we spoke about the definition of an asset. Remember, an asset is a resource that's controlled that will give rise to future economic benefits. Okay, so assets generate income. Right, the operational capacity is determined by the amount of assets that you have in a particular company. Okay, so a company that has more assets would have more capacity. Right, and that obviously determines their production. Okay, or what they can do. Right, so property, plant, and equipment. This particular section is looking at non-current assets. Okay, we're looking at long-term assets that are tangible. Why? Because they're operational assets that are going to either increase or reduce our capacity. Okay, so companies that have more, okay, in terms of assets would have better capacity. Okay, they'd be able to do more with what they've got. Right, where are we going to see these accounts being recorded?
In the journals.
Okay, the journals is somewhere where you would record transactions. So if I buy, let's say land or a building or a vehicle, will I record that in a journal?
No.
Yes.
Oh, okay, gotcha.
Okay, so the journal would record the transaction, but where will we see the accounts?
In the statement of financial position.
Okay, yes, so that's disclosure. Okay, so you've actually answered the second question. Is disclosure important? Yes. Right, you'll see that in the statement of financial position. Okay, but stakeholders want to see more detail. Okay, so what are we going to see? We're going to see a note. Okay, so the financial statement note is where we're going to see all the information about the assets. Okay, disclosure is important and stakeholders want to see detail, obviously. Okay, we know that decision making is key.
Yes.
Right, so financial statements will summarize the accounting information, but we need to refer to the details for specific, let's say, topics in terms of, let's say, the number of years. Okay, so how long is the asset going to be used for?
Yeah.
The useful life. Okay, how are you going to depreciate the asset? Okay, and that's what we'll look at here in terms of the notes. Okay, and the notes will obviously have detail, so the disclosure is going to be a lot more detailed. Okay, you'll have more columns, you'll have more line items because you need to show everything relating to the assets. Okay. Right. Property, plant, and equipment. In terms of non-current assets, we know they're tangible or intangible. Obviously, the asset we're looking at here is tangible. Okay, because it's property, plant, and equipment. All of these assets are tangible. Okay, they're physical assets that you can see and touch and use. Okay, they're not intangible. Intangible would be things like copyright, websites. Those are items that aren't physical assets. Okay, but that is probably a different module. You've got your textbook there.
Yeah.
Just checking the contents. Do you look at intangibles as well? Okay, you do. Okay,
yeah.
So that you'll look at in a separate section. Okay, looking at assets that aren't fixed assets.
Yeah.
Right, you also get financial assets, things like shares, things like bonds. Those are all financial assets. Okay, the definition of a tangible asset is obviously fixed. Okay, it's buildings, machinery, vehicles, and so on, and it needs to be written off over its useful life. Okay, so what do we call that writing off of an asset over its useful life?
Depreciation.
Exactly. Okay, so depreciation is what we're going to be looking at. Okay, that's important. Why? Because we need to understand what it is. Okay, so what is depreciation? It's the use of an asset over time.
Yeah.
Okay, so the more I use the asset, the more depreciation I'll have.
Exactly.
Okay. Right, the next bit is the recognizing of its costs. Okay, so when I buy property, plant, and equipment, will there be a cost?
Yeah.
Yes. Will that cost change?
Yeah. No, it won't.
No.
It always remains the same.
Why?
Because it's what you purchased it at.
Correct. It's based on what you purchased it at. Okay, so the historical costs will never ever change. Okay, if I buy something at 1 million, it's going to cost 1 million.
Yeah.
I can't change that unless I go back in time and undo the transaction. Okay, so when looking at property, plant, and equipment, and that's the same as inventory. Okay, inventory also gets measured at Historical cost. Why? When you buy something, it's worth something.
Yeah.
Okay. So what can I include in the historical cost? Well, I include all other costs relating to setup. Okay, so installation, setup, etc. Okay, I need to get the asset in a usable state before I can depreciate it. Okay, because remember, depreciation is what? The use of an asset. Okay, the asset can't be used if it isn't set up or installed. Okay, so I need to first set up or install the asset, and that determines its total historical cost. Okay, so historical cost meaning everything that's part of the asset, to get it in a usable state. Okay, once it's usable, then I can start depreciating it. Okay. Right, non-current assets need to be monitored and controlled. And you asked me about an asset register in the first session. So an asset register is just a way to keep record or track of all the details. Okay, so every asset we have, all the chairs and tables in the business, all the computers, all the printers, all the vehicles, all the land, all the equipment, everything needs to be kept on a register. Okay, location, price, date, lifespan, depreciation, all the details. Okay, the size, the characteristics, what type of equipment do you have, all of that must be kept in a register. Okay, and that's just background information. Okay, I doubt they'll ask you to draw up a asset register.
I was just going to ask you.
Okay, here's a note about recording the purchase. Okay, so we spoke a little bit about different transactions. Okay, debits and credits. Okay, so here we have property, plant, and equipment. If I'm buying PPE, what accounts am I affecting?
Asset.
Yes. What's happening to the asset?
It's increasing.
It's increasing. And where do I increase assets?
On the debit side.
Exactly. Okay, so whatever it is, I'll debit that property, plant, and equipment. It could be property, it could be plant, it could be equipment, it could be anything. Okay. And why do I credit bank?
Because your assets decreasing. Because bank's an asset.
So how did I buy the asset if I debited property, plant, and equipment and credited bank? Cash. Okay, so a cash purchase would be credit bank. A credit purchase would be credit creditors. Why? It's a liability. Okay, so you're either increasing the asset and decreasing the asset, or you're increasing the asset and increasing the liability, depending on
what it is,
how you're purchasing the asset, how you're financing the asset. So that's finance. This is just the accounts. Okay. Right, accounting for the depreciation. We know what it is. We spoke about it. What is it?
Depreciation and expense. All of that definition.
Okay, yeah. It's the use of
the
asset. That's what it is. It's just the use. Okay, so the more you use something, the more depreciation you'll have. Okay, and the more depreciation I have, the bigger the expense is going to be. Okay, so you said expense is good, okay, because now you know what the account is. Remember, it's always key to identify what you've got in the question. Okay, so is it an expense? Is it a asset? Is it a liability? What do you have? Okay, so the steps would be to first identify what it is. It's an expense. Okay, if it's an expense, it'll be recorded where? In the statement of comprehensive income. Okay, why? Because the statement of comprehensive income is going to measure your performance. Okay, remember, that's profit or loss.
Okay, gotcha.
Okay, so how do I calculate a profit or loss? I take all my income and I minus all my expenses. Right, so expenses would be disclosed there. Okay. Where would you disclose this, the accumulated depreciation? Well, we first need to know what it is. Okay, this might be a new account. Okay, it's a negative asset. Why? Because of disclosure. It affects the asset. Okay, the asset will reduce in value because I've got depreciation. And if it's accumulated, what does that mean?
It's over a period of time.
It's over the entire lifespan of the asset, correct? Okay, so the longer I hold something, the more accumulated depreciation I'll have. Okay, so what is the difference between the asset's cost and accumulated depreciation? What do we call that?
The difference between them.
Yeah, if I take cost and I minus that, accumulated depreciation, what do I get?
Oh, that's the carrying value, isn't it?
Yes. Okay, so carrying or book value is cost minus accumulated depreciation. See, these are basic principles. Okay, we need the basic principles because of disclosure. Okay, in the note, you show your carrying value, you show your cost, you show your accumulated depreciation. Okay, you show all three things. Okay. Right, the next bit here is just a note for students to remember in terms of timelines. It's important to draw a timeline, especially when questions are more complicated. Okay, and the more complex the question, the more difficult it is to make a mistake.
Yeah.
Okay, so I've put a note here for depreciation. We know what it is. The use of an asset for a specific duration of time. Okay, and that's why a timeline is key. Because if I draw a time and I've got the beginning of the year and I've got the end of the year, okay, what is depreciation? The use.
Yeah.
Right, so if I use the asset for the entire year, will I have depreciation for the entire year?
Yeah.
Yes. If I use the asset for half the year, then I sell it. How much depreciation will I have?
6 months.
Yes. Okay, I'll have half the year worth of depreciation. Okay, so it doesn't matter if I have the asset or if I don't have the asset. That's not important. The point that I'm trying to make here is if you use the asset,
Yeah.
you'll have depreciation.
Okay.
Okay, it doesn't matter if you've got it or not. You could have sold the asset. If you sell the asset, do you still have it? No.
Yeah, it's
Okay, but you've still used it
Yeah.
for half the year. Okay, so this will be the depreciation that you would have to record for half the year.
Okay.
Okay, you can't not show it because it shows you what happened during the year.
Yeah.
Okay, if you don't show your users that you had an asset that you used for 6 months, right, you're not telling your users the truth. Okay, the truth is you had an asset that you sold.
Yeah.
Okay, you used the asset for half the year, you must record the depreciation for half the year. Right, then you've got a note about the use of a table. Right, so these headings are key for doing calculations. Okay, we'll see how to use these later. Okay, I've got a few examples for you to try. Okay, so cost, depreciation, accumulated depreciation, and carrying value. Right, those are 4 different headings that you would need for any depreciation calculation. It can be straight line, diminishing balance, it doesn't matter.
Yeah.
Okay, but you're going to need those headings to do the calculations.
This looks like a nice method. I've never used it before.
Have you not used it before?
We don't use these, no.
Okay, but yeah, you'll see it. It's quite easy to use.
Yeah.
Okay, because certain things change and certain things don't. Okay, if we know how to use the table, we'll know how to get the right answer.
I like it.
Alright, so those are your 2 methods. There's a straight line method and there's a diminishing balance method. Straight line is based on what? Cost. That's the key word. Okay, and that's why it's in orange. Okay, straight line, cost. Diminishing balance, carrying value. Okay, so that's the base that you're going to be using as the basis of the calculation.
Yeah.
Okay, so if I'm working out straight line, is the amount going to change? No, it's a regular amount. And why is it regular? Because we spoke about the cost. Will the cost change?
No.
No. So the cost won't change. The depreciation won't change. Okay. The depreciation will be fixed. It will be regular because it's based on an amount that isn't going to change. Okay. If the cost changed, then it would change the depreciation.
Okay.
Okay.
Yeah, that makes sense.
Diminishing balance, it's based on the carrying value. Will the carrying value change?
Yeah.
Yes. Why?
Because of the accumulated depreciation.
Correct. Because carrying value is cost minus accumulated depreciation. Right. And will I have more accumulated depreciation? Yes, over a longer period of time. Okay, so depending on how long I've used the asset, I'll either have more or less depreciation. Okay, so the point that I want to leave you with here is scrap value. So do we have a scrap value for straight line?
Is that the residual?
Yes, okay, that's the residual, that's the scrap value. Okay, so depending on the textbook that you're using, they either refer to the scrap value or residual value. Okay, is that going to make a difference?
Yeah.
Yes, it will. Okay, why? A residual value is what? Something that you have at the end.
Yeah.
Okay, so if I have that amount at the end, okay, have I used that during the life of the asset?
No.
No. Okay, so do I depreciate the residual value? No, you wouldn't.
No.
Okay, you'd have to take the residual value out to depreciate the asset.
Oh.
Okay, so you don't depreciate something that you can't use. Okay, you're not going to use that value, inverted commas. Okay, the value isn't being used. Why? It's the value at the end.
That makes sense.
Okay, so if I don't use that asset, I can't depreciate it.
Okay.
Okay, if I use it, then I will depreciate it. Okay, so the scrap value we take out. Okay, what is the asset worth at the end of its useful life? If I've got straight line, it's actually 0. Okay, because remember, you depreciate up until 0. And if it's straight line, you'll actually have 0 at the end of its useful life. Okay, but normally assets will have a scrap or a residual value. Okay, so there'll normally always be something left over.
Okay.
Okay, with diminishing balance, is there a scrap value?
Yeah.
There's always a scrap value. Why? The diminishing balance will never ever reach zero. Okay, because it's repetitive. Right, the carrying value will get smaller and smaller and smaller. It'll tend towards zero, but it'll never ever get to zero.
Okay.
Okay, because scrap value. So diminishing balance actually provides for an amount every year. Okay, because the depreciation gets smaller and smaller and smaller. So it's almost like it's providing for a scrap value. Okay, so that's just the theory. Okay, we've got two methods, straight line, diminishing balance. The one uses cost, the one uses carrying value.
Do you, for the units of production method, do you use residual as well?
No, units of production is generally straight line.
Okay.
Okay.
Oh, and then also for straight line, that was one of the issues I had.
Yeah, we'll look at the examples just now. Okay, let's just finish the theory and then we'll come
No, it's
to...
part of the theory. If it's a percentage of the... Okay, well, I guess it's part of the formula. We haven't done the formula yet, so I'll wait for that.
Okay, alright, yeah, so these are some calculations. Right, so here we've got PPE. We've got the straight line method. That's method number 1.
Yeah.
Okay, what is straight line using? The cost.
Okay.
Alright, so in example A, the asset was bought for 500,000. Useful life is 5 years. Okay, how much percent per annum would that be?
5 years. Ooh, no idea.
5 years is the same as 20% per annum. How did I get that? 100% is the total, and if I divide that by 5 years, I'm going to get 20%. Okay, so your examiner will obviously give you either percentages or years. Okay, we won't know which they'll give, right? But if they give you 5 years, right, it's the same as 20% per annum.
Okay.
Okay, because over the 5 years, I'm going to depreciate the asset 100%.
100%.
Okay. Right, so 20% is the same as 5 years. It doesn't matter how you do it. If you divide by 5 or you times by 20%, it's the same thing.
Okay.
Okay. Right, so I want to know, what is the yearly depreciation if the asset's worth 500?
It's 500,000 divided by 5.
Which is?
100,000.
100,000. Okay. Let's write that down. 100,000 per annum. What is that? That's the yearly depreciation. Will that change?
No.
No. Okay, so after year 1, how much depreciation will I have?
100,000.
100,000. After year 2, how much accumulated depreciation will I have?
200,000.
200. Okay, that'll accumulate and accumulate and accumulate until you reach 500. Okay, after 5 years, what would the cost be?
Cost will be the same, wouldn't it?
Cost won't change.
Yeah.
Okay, so the cost is 500,000. Okay, but what happens to the accumulated depreciation after 5 years? It'll be 500,000. Yeah. Okay, so 500,000 minus 500,000 gives me what?
0.
Gives me nothing. Okay, gives me 0. Okay, so do you agree after 5 years you've got 0 as a carrying value? Okay, after 5 years. Okay, because the asset is actually worth nothing if I'm using the straight line method.
Okay.
Okay. Right, here's one for you to try, but I've given you a percentage instead of years. Okay, 25% will be the same as?
4.
4 years. Okay, 4 times 25 is 100.
Yeah.
Okay, so depending on how they give it to you in the question, in the exam, it'll either be this or it'll be that. Okay, it doesn't really matter. It's the same. Okay, as long as you can work out the depreciation, that's important. Okay, so maybe quickly work that out and see what you get. Alright, yeah, so to work out the yearly depreciation, 960 divided by 4. Okay, it gives you the yearly depreciation, which you got as?
240,000.
Was it 240?
Well, I did times 25%.
Yeah, or times 25%, it's fine. Okay, so 960,000 times 25% is 240,000 per annum.
Yeah.
Okay, and that will accumulate.
Yeah.
Alright, so 240 per annum is the yearly depreciation. Yeah. Right, so let's change the focus now. Let's see if you can work out diminishing balance. Okay, this requires what? A table. Why?
Because it's got carrying value.
The amounts are going to change. Okay, so because I've got the diminishing balance method and because it uses the carrying value, I need to use my table. Okay, so I'm going to do the working here. Cost, okay, depreciation, accumulated depreciation, and carrying value. Right, we saw this table earlier. Okay, now we're using it. All right, so we need the cost, we need the depreciation, we need the accumulated depreciation, and we need to get the carrying value. Okay, so that's what we're going to be drawing up for this particular question. Okay, obviously we're going to look at different years. Okay, so obviously when I buy the asset, I'll have
year one.
Well, I won't have any depreciation when I buy the asset. Okay, that's the start. Okay, but I'll have 1 year, 2, 3, 4, 5. How many years do I have here? 5 years. Okay, so the asset is bought for 500. It's the same asset. We're just using a different method. Okay, in example A, we used straight line. In example C, we're using diminishing balance. But the amount is the same. 500,000 costs, 5 years depreciation. Okay. Right, so if we go back to the table, okay, is the cost going to change?
No.
No. What is the cost?
500,000.
500,000. Okay, so I'm going to put 500,000 for all 5 years. Okay, the reason for that is it's historical cost. I can't change what has happened in history in the past.
Of course.
Okay, so this will always be the same.
Yes.
Okay, this will be different every single year. Why?
Because
it's based on carrying value. Okay, and what is carrying value? It's the current worth of the asset at a moment in time. Okay, so if I want to know what is the asset worth today, I'm going to look at how old is the asset, how much depreciation do I have to work out what its worth is. Okay. Exactly. Okay. All right, so what am I going to do for the first year?
Depreciation.
Yes. And will that change from straight line?
No, not the
No, it'll be the same for the first year. Okay, so I take the 500,000 and I divide that by 5. Depreciation is
100,000.
100,000. Okay, how much accumulated depreciation will I have at the end of year one?
100,000.
100,000. Right, so if I know what the cost is and I know what the accumulated is, how do I get the carrying value?
500 minus 100.
Yes, cost minus accumulated depreciation. Okay, so this column minus that column will give me 400,000.
Okay.
Okay, now I need to work out this, the depreciation. Okay, and the depreciation there is going to be calculated on what amount?
So the 400,000.
Exactly.
Divided by the 4.
Correct. Okay, why? This is diminishing balance.
Yeah.
So diminishing balance uses what? Carrying value.
Yes.
Okay, so if I take the carrying value and I times by 20% or I divide it by 5, I get 80,000.
So
okay, what is that? That's the depreciation for which year?
Year 2.
For the second year. Okay, so that's depreciation for year 2. What is accumulated for year 2?
180,000.
Why?
Because you add the both years together.
Because now the asset's 2 years old. Okay, so I'm going to have to add last year's plus this year's.
Okay.
Okay, so carrying value?
Would be, you'd still take your cost minus your accumulated. Okay, so it'd be 320,000.
Yeah.
Okay.
Okay, how do I get this amount?
320 divided by 3.
Okay, again, good. I use this, the carrying value. Okay, so carrying value divide by 5 gives me...
To divide by 5 or divide by 3?
I divide by 5 because the question said 5 years useful life. Okay, which is the same as 20%.
Oh, so you don't change the
You don't change the years.
Okay.
Okay, just keep it as 5 or keep it as 20%. Okay, the 20% won't change and the 5 years won't change.
Okay.
Alright, so I'm just going to divide by 5 again, while times by 20% again.
Okay, got you.
What's accumulated now?
So that's 55 180 plus 64,000.
Why?
So, because you got to add for 3 years, yeah?
Exactly, because now the asset is 3 years old. Okay, so you're adding last year's total depreciation, which is 180, plus this year's 64 gives you 244. Right, same question here. Carrying value, how do I get it?
Cost minus the 244.
Cost minus the 244. Exactly.
Great.
Okay, last two lines. Okay, again, I'm going to take the 256 here. Why? Because to work out year 4's depreciation, I need to work out 20% of
carrying value from the year before.
Yes, the previous carrying value. Okay, we'll divide by 5 again.
Yeah.
Right, and then how do I get the accumulated? Last year's plus this year's. Right, so 244 plus 1 plus 51. So I'm taking that amount and I'm adding that amount to get that answer.
Yeah.
Okay. Then to get the carrying value, costs minus accumulated gives me 204, 800.
Yeah.
Right, and then the last line would be the same thing again. Take the carrying value, divide by 5 or times 20%, either or. Okay. To get the accumulated, I take last year's plus this year's. Okay, and the carrying value at the end would be that amount. Okay. Right, so costs minus accumulated. So this costs minus accumulated gives me carrying value. This minus that gives me that answer. Okay, so what is the asset worth?
At the end,
163,840.
Yeah.
Okay, notice that's different to what we had earlier.
Yeah.
We had 0 here earlier. Straight line. Okay, when we use the straight line, so straight line method, bracket example A, we had 0 at the end of 5 years. Right, here we have 163,840. Right, and we could keep on going with this table. Okay, have a look here. If I keep going with the table to 12 years, okay, right, what happens? The amounts get smaller and smaller and smaller, but they never get to 0. Okay, so it tends towards 0.
Oh, okay.
Okay, but you'll always have a carrying value for what? Diminishing balance. Diminishing balance. Okay, so with the diminishing balance method, you'll always have what? A carrying value. It'll get smaller and smaller and smaller. It's a repetitive process. But the amount will never ever get to 0. It will tend towards 0. It won't ever reach 0.
Okay.
Okay.
Yeah.
Right, so that's one example. That's example C. Okay. We looked at all of this. There's the correct answer. We should be getting that. 163,840, which we did.
Yeah.
Okay, so now I've done an example with you. Okay, on the next slide, there's one for you to try. Okay, so maybe over here, again, let's pause. Okay, give you a chance to complete the table. I've only given you 25% here, so how many years?
4.
4 years.
Yeah.
Okay, so there aren't as many lines. Okay, 25% is the same as 4 years. All right, so again, let's pause and let's see if you can do that. Alright, so to look at that question, okay, I'm going to use the same table again. I'm only going to need 4 years. Okay, so the cost was 960 here. Okay, and the depreciation was 4 years. Okay, so 960, okay, will be the depreciation is divided by 4. Divide by 4. Okay, and then the accumulated is this plus that. Okay, and this would be this minus that.
Yeah.
Okay, so did you get all of those answers?
Yeah.
Okay, good. So that's the table that you would draw up for this particular question. Okay, final answer here in terms of carrying value at the end of 4 years would be 303750. 50. Again, that's very different to what we had earlier. Okay, what we had earlier for straight line, you ended up with 0. Okay, because after every year we wrote off the asset. Okay, we landed up with 0. Okay, so here we've got 303, which is the carrying value at the end of 4 years. Right, and we've got the depreciation each year, and we've got the accumulated for the year. Right, so just another note, when you do draw up a table like this, remember we read line by line. Okay, so when I look at that line, all of that relates to what year?
Year 2.
Year 2. Okay, don't mix the lines, because each year will have a different amount of depreciation in terms of the accumulated and a different carrying value. Okay, when looking at this particular table. Okay, so always look at it line by line. Okay, because remember later you'll look at disclosure. So with disclosure, okay, if I was disclosing for year 2, then I would show this carrying value on the statement of financial position, and I would show that depreciation where? In the statement of comprehensive income.
That's statement of profit and loss, right?
Profit and loss, comprehensive income.
Yeah.
Okay, because remember the depreciation, actually, I should have said that. Okay, statement of comprehensive income, profit and loss.
Yeah.
You would show depreciation for year 2 as 180,000. Okay, accumulated depreciation, so those two amounts. Okay, that'll go into your statement of financial position, yes. Okay, disclosure in terms of the costs less the accumulated depreciation. Okay. Alright, so that's just disclosure, just to mention that as well. Okay. Alright, so to come back to the notes, let's carry on. Okay, so we've covered 2. There's the note about the units of production. Okay, so depending on how many units you've produced, you would then either increase or decrease the depreciation. Okay, so if I'm looking at an asset that'll be producing 10,000 units. Okay, 10,000 units manufactured over 10 years. Right, obviously depending on how much I produce each year, I'll have a different amount of depreciation. Okay, because what is this doing? This is taking the 10,000 that I'm going to be producing, and I'm going to be splitting the use over
10 years.
Time. 10 years. Okay, so if I manufacture, let's say I manufacture 1,500 units in year 1. How much will I have as depreciation? Depreciation will be the cost, which won't change. Okay, times the production. How much did I produce?
150.
150,000. 1,500. Okay. And?
Over 10,000.
Over 10,000 units. Right. So that's the fraction that you're going to be using for the depreciation. Okay. So it's just another method. Right. It's not very popular to do it this way. Okay. Unless you're actually monitoring how many units you're going to produce. Right. Then you would do that. This could be made for specific projects. Okay. So maybe the item is only going to last you for 10,000 units. Then to apply the depreciation in this method, that could work. Okay, but generally you would use a percentage, or a number of years. All right, here's a note about disclosure. What is this? It's the note. Okay, so if it's the note, what do you see? You see detail. Okay, so this is key. Okay, the detail. Obviously, you need to know what the format looks like. Okay, so this would have been covered in your textbook as well as IFRS. They guide you in terms of what the statements must look like. Okay, so if I've got carrying value, I'll have a carrying value at the beginning, and I'll have a carrying value at the end. Okay, do I change the formula? No. How do I calculate carrying value?
Cost minus active.
Cost minus accumulated depreciation. Right, so if I'm looking at the start, that's the cost of the asset, that's the accumulated depreciation for the asset. Okay, so we don't know how old the asset is, but we know the asset has been used. Right, because there's accumulated depreciation. Okay, if I take the 160 minus the 32, I get the 128. Okay, what were the transactions for the year? Well, I bought more equipment or land or buildings, whatever it is, okay, and I bought 150,000. Okay, what does that do? Does that increase the cost or the carrying value?
Carrying value.
It increases the cost because that's the amount that I've bought.
Oh, of course.
Okay, so I've bought 150. So how much do I have at the end of the year?
160 plus 150, so 210.
310, yes. Okay, so that 310 comes from the 160 plus the 150. That's where it comes from. Okay, so cost at the end is what you started with plus what you bought during the year.
Yeah.
Right, no disposals here. Okay, we'll discuss that later in the next slide. Okay, and then depreciation is what? The use of the asset. Okay, so what figure is this going to change?
That's going to change the carrying value. No?
It's going to change the carrying value, but it'll change the carrying value because this will be affected.
Yeah.
How much did you start with?
320.
32. How much did you end with?
47.
Well, plus 47.
Yeah.
Right, so what would this final figure be?
Those two added together, yeah?
Yes. 32 plus 47.
79.
Correct. Okay, so now you've got 79,000 as what?
Your final accumulated depreciation.
Yes, so what is the final carrying value?
310,000 minus 79,000.
Which is?
231,000.
231. Okay, and that's the note. That's how you drop the note. Okay, remember the note is just how we present information.
Yeah.
Okay, where do we get all these figures? From your calculations, from your workings, either from a timeline or a table. Okay, so here's a note about timing. If an asset is purchased during the financial year, how do we calculate depreciation?
You just multiply by the amount of months you've got it, no?
Yes, and we call that pro rata.
Okay.
Okay, so pro rata depreciation will be depreciation for only part of the year. Okay, I can't depreciate it for the whole year because I haven't used it for the whole year. Okay, remember I only depreciate for?
However long you've used it.
Exactly. Okay, the time or duration that I've used the asset for. Okay, so here's an example. A new asset is worth 800,000. Okay, it's purchased 4 months before the end of the year. Depreciation is 25% per annum using the straight line method. What would the depreciation be for the first year?
So you've got 800 times 25% times 4. No. Yeah, 4 over 12, right?
Why 4 over 12?
Because you've only purchased it 4 months before the end of the year, so
Exactly.
you're only going to have it for 4 months, right?
Yeah, you're looking at the time that you've used it for. That's correct. Okay, so you only depreciate for the
time you've got it.
Use. Okay, so I've only used it for 4 months. I can only depreciate it for 4 months. Okay, so depreciation for 4 months will be 66,667. Right, depreciation for a year will be 200,000. Okay, so will I have the asset for the entire year next year?
Yeah.
Yes, unless I sell it.
Okay.
How much depreciation will I have next year?
200,000.
Why?
Because it's a straight line method, so it depreciates the same every year.
It doesn't change, yeah.
Yeah.
Okay, and what's the carrying value then at the end of year 1?
You take your cost minus 200,000.
No.
At the end of year 1, sorry, minus the
Yes.
6666, yeah.
Okay, you can only minus what you have as accumulated depreciation.
Yeah.
So how old is the asset after year 1?
1 year old.
4 months.
Oh, only 4 months, of course, you bought it.
Okay, so costs minus accumulated. Same thing applies. Costs at 800, accumulated 66. Carrying value 733. Okay.
Great.
Alright, then the last bit here is just the disposal. Okay, so what is a disposal? It's the selling or writing off or trading of an asset. Okay, so I'm getting rid of it, basically.
Yeah.
I'm de-recognizing the asset from my books.
Okay.
Okay, so if I take an asset out of my books, what do I need to do? I need to do a working. Okay, so the working will be a realization account. Okay, depending on what textbook you're using, they'll either talk about an asset disposal account or asset realization account. So which do you use?
I think asset disposal account.
You use asset disposal.
Yeah.
Okay, so a little bit different. Okay, but it can be realization or disposal, doesn't matter, it's the same thing. Okay, it processes what? The writing off, trading in, or selling of an asset. Okay, so getting rid of an asset, I need to use this, which is a working account. Okay, so you do a working. And what is the working that you do? It's the realization account or the disposal account. Okay, so there's a general process here. If you want to learn a process, you can rather understand what you're doing. Okay, so what am I trying to do? I'm trying to get rid of a asset. Okay, so I'm going to have to process the carrying value. I'm going to have to take out the depreciation. I'm going to have to take out the costs.
Okay.
And then I'm going to have to work out a profit or loss. All right, so this is the calculation that you do. Okay, so this is the general ledger account that will help you work out what? A disposal. Okay, so how do I work out an asset realization or disposal? Okay, I need to determine three things. Okay, what are the proceeds? What is the carrying value? And is there a profit or a loss? Right, so how do I get carrying value?
You take cost minus the accumulated depreciation.
Cost minus accumulated depreciation. Okay, so I need to work out depreciation before I can calculate it.
Yeah.
Proceeds come from the question.
Yeah.
Profit or loss comes from where?
Sold, no? Two.
Comes from the difference between
Those two.
Okay, so if your proceeds are greater than carrying value, I'll end up with a profit. If proceeds are less than carrying value, I'll end up with a loss. Okay, and those are the two scenarios you can get. Okay, so in the asset realization account, what am I going to put in the T account? What will go on the left-hand side or the debit side of the account?
No idea, we've never done this.
Okay, so let's think about it. What am I doing to my asset?
Do you recognize it?
I'm getting rid of an asset. So let's say the asset is a vehicle.
Oh, so you would put on the...
Okay, what balance will the vehicle have?
I know it would have a debit balance, right?
Exactly. So how would I get rid of this vehicle?
You credit it.
So if I credit this account, what would I do to this account?
Oh, you debit it.
Exactly. Okay, so the debit will be the cost.
Oh, okay.
Okay, so you'll put the cost here. Okay. Why? Because you're crediting the vehicle and you're debiting the working account. Okay, so you're applying your rules now. Remember those rules that we learned in the first session? Okay, the better we know those rules, the easier this is, because now we're just applying what we already know. Okay, so what am I doing? I'm getting rid of a vehicle. Okay, we know a vehicle has what account? A debit account. Okay, so that account has a debit. To get rid of it, I need to process a credit. Okay, and that's why the credit will be the balancing figure that removes that completely, and then I need to debit something else, which is the realization account. Okay, next bit. What goes on this side of the account?
You've just done the vehicle.
I've done the cost.
The cost. Oh, the depreciation.
The depreciation, exactly. Okay, again, what type of balance will depreciation have?
Also debit balance.
No.
Isn't it an expense?
Accumulated depreciation.
Oh, accumulated depreciation. You said depreciation.
Has?
Credit balance.
A credit balance.
Asset,
yeah, because remember, you create by the depreciation.
Yeah.
Okay, but this account will have a balance.
Yeah.
Will depreciation have a balance?
No.
No, because every year it gets closed off to profit and loss. Okay.
Yeah.
So if this account has a balance, which is a credit, how do I close this account off?
You've got to debit it.
I debit the account. So if I debit this account, I must credit
this one.
That account, exactly. Okay. And that's where those things come from. See, that's the understanding. So what am I doing? I'm getting rid of the accumulated depreciation. DOS is date of sale. Okay, remember I take the depreciation at the date that I'm selling it. Okay, so depending on how old the asset is, I'm going to take all that depreciation through. Okay, right. Then I've got a few other things that I've added here. Okay, these are new things that you probably haven't seen yet. Okay, we've covered the cost and the accumulated. So these are 3 other points that will be part of this account. Okay. You won't have a profit and a loss. You'll have either or.
Yeah.
Okay, so let's start with the easy one, bank. Why do I credit the asset realization account with bank?
Is bank your debit because you're getting money?
Exactly.
So
okay, because you would have debited the bank, so you would credit the asset realization.
Yeah.
Right, and that's why we've got that account there.
Yeah.
Okay, that's the reason, that's the why. Okay, why do I have profit on sale on the debit side?
Because of profits and income, so it would have a credit balance.
Correct.
So
okay, profit on sale would have the credit. So you would credit the profit on sale and you would debit the asset realization. Exactly.
Okay.
Okay, and the same thing here. Why would you have a loss on sale on this side?
Because you'd have a debit balance because it's an expense, right?
Because you would debit the loss on sale, which is the expense,
yeah.
and you'd credit the
asset realization.
Asset realization. Right, so note, closing off this account. No opening or closing balances. Why not? Why won't we ever have an opening or closing balance on the asset realization account?
I have no idea.
It's a working. Okay, so working accounts always have what? No balances. They get closed off. Okay, you close this account off.
Okay.
Right, NB, these basic rules still apply, and it's applied to the working account. Okay, so it doesn't matter what the account is, you still apply the same rules. Okay, there's the rules again. Okay, so don't forget to learn these rules well, know them, right, and then apply them. Okay, so if I'm looking at removing or disposing of an asset, which accounts am I focusing on? Those. Assets, income, and expenses. That's it. I don't look at capital drains and liabilities because that doesn't apply to a asset realization question because I'm realizing proceeds.
Okay.
Right, so either the asset will increase, it could be debtors,
yeah,
or it could be bank, but an asset will be increasing.
Okay. And what account does it get closed off to, the asset realization?
Asset realization closes itself off.
Oh, okay.
Okay, because remember, this cost would have come from where? The asset.
Yeah.
Okay, so let's say you had vehicles.
Yeah.
Okay, so I had a debit, I had a credit, and there's the debit.
Yeah.
Okay, so that gets closed off.
Okay.
Right, here, accumulated depreciation. I would have had accumulated depreciation with what balance? A credit.
Yeah.
I would have debited it,
so it gets
and I would have credited that. Okay, so that would have got closed off. Okay, this bank would have gone to the bank account.
Yeah.
Okay, in bank I would have a debit here and I'd have the credit there.
Okay.
Okay, so those accounts will be recorded. Okay, this account gets closed off because the balancing figure, okay, whichever side's bigger, the debit or the credit side,
yeah,
you'll either be left with a profit or a loss. Okay, so generally the balancing figure is what?
Profit.
The profit or loss. Okay, and that balances the account.
Oh, okay, got you.
Okay, so you'll either have this or you'll have that.
Okay.
Okay, you won't have both. It'll be one or the
Yeah.
other, depending on which side's bigger.
Okay.
Right.